Ready for your financial breakthrough? Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and bring you to the next level. Beginners or experienced, this is your one-stop shop for all things financial literacy. Okay, so you want to start investing in the stock market, but you don't know where to begin. Well then, you're in luck, because in this video, we are going to give you Peter Lynch's ultimate guide to stock investing. So, who exactly is Peter Lynch, you ask? Well, he is one of the most successful fund managers in history, managing Fidelity's Magellan Fund from 1977 to 1990 and producing an average annual return of 29%, making him one of the finest fund managers of all time in history. Why is he important to you then? Well, it's because he can teach you how to invest in the stock market successfully. You really don't need a finance degree to benefit from his investment plan, so don't be worried. For Peter Lynch, investing requires patience, discipline, and the ability to understand companies, their financials, and market trends. He is a long-term investor who believes that buying and holding companies for years rather than months produces more favorable outcomes. So, what is his investment strategy? It is all about investing in your knowledge and expanding your wealth. Lynch does not like the idea of over-diversification because it causes him to lose focus. He suggests investing in no more than 10 to 20 shares and no more than 5% of one's portfolio in any single stock. Also, his investment strategy involves examining companies' financials in order to get a comprehensive view of their development potential, financial position, and the value of what they own and owe. He recommends focusing on buying great companies at good prices, rather than good companies at great prices. Peter Lynch's approach is very simple and easy to understand, making it perfect for beginners. By the end of this video, you will learn how to research companies, buy and hold stocks, gain a long-term investing mindset, and reduce risks. So stick around until the end to know the ultimate guide, and who knows, you might be the next Peter Lynch in history. If you don't know yet, Peter Lynch developed the concept of invest in what you know. His main point is that, as an investor, it is better to invest in industries or businesses that you understand very well. Now, what exactly is his investment strategy? He believes in fundamental assessment and that investments should be founded on thorough study, patience, and a long-term perspective. Investing in good companies, understanding their potential for growth, and avoiding market timing are all important components of his investment strategy. Key principles of Peter Lynch investment strategy diversification is essential in his investment approach. A diversified portfolio should include a variety of asset classes, such as bonds, stocks, and mutual funds, to reduce the chance that a single asset class may negatively affect the whole portfolio. Investing in what you know is a critical aspect of his investment philosophy. He suggests investing in products that one uses regularly and understands, such as investing in companies that produce a particular product or service to which one relates. This helps to build a deeper understanding of the company's prospects and potential for growth. Fundamental analysis is also important because it serves as the basis for knowing good companies. This analysis involves going over a company's financial accounts, evaluating its management, comprehending its growth potential, and assessing the industry's growth potential. Avoiding market timing is a critical component of Lynch's strategy because market timing frequently causes missed opportunities. Instead, he highlights the need to focus on the company's long-term fundamentals rather than being persuaded by short-term market volatility. Patience is a must because it helps investors stay invested for the long term while avoiding behavioral biases such as panic selling or greed-driven investments. Lynch's investment philosophy emphasizes the value of patience, research, and a long-term perspective. Following these fundamental ideas can help investors build an appealing portfolio. Of course, his strategies are very important in starting out your portfolio. You must also continue to work hard as an investor to maintain your portfolio. His investment strategies are time-tested and can help investors create a successful one. His emphasis on patience, study, and a long-term perspective has made him a money-making legend. Researching companies and buying stocks. Next, if you are looking to invest in the stock market, it's crucial to research the company you're interested in. Let's go back to fundamental analysis again. Peter Lynch highlights the importance of basic research when deciding whether or not a company is a smart investment. Thorough research is necessary for making an informed decision, and there are numerous approaches to take. Reading a company's annual report is a good method to learn about its financial state, competitive landscape, and growth prospects. You can also look at their SEC filings or visit their website for more information. Timing is another key thing to consider when purchasing stocks. When an investment is at an all-time high, it can be tempting to buy, but this is not always the best plan. Lynch believes that having patience and waiting for the proper time to buy is crucial. He also recommended that the story behind the investment be updated and checked on a regular basis to guarantee that the stock remains a solid investment. Finally, while purchasing stocks, it is important to decide the appropriate price to pay. Lynch defines this as understanding a company's growth potential and ensuring that you are not overpaying for its earnings growth rate. He also emphasized the importance of investing in solid ideas over waiting for the perfect buying opportunity. In short, researching companies, identifying the best time to buy, and determining the best price to pay are all important factors to consider while investing in the stock market. Take the time to do thorough research, be patient with your investing approach, and be willing to pay a reasonable price for a quality investment opportunity. Investment strategies for beginners. Investing in the stock market can be intimidating, especially for beginners. But don't worry, we are here to guide you to become the next Peter Lynch, and fortunately, there are investment strategies that can help mitigate the risks, aid in decision-making, and set achievable goals. Investing in stock mutual funds is one such strategy. Equity mutual funds allow beginners to invest in stocks without conducting considerable research or closely monitoring the performance of individual stocks. Mutual funds are managed by professionals who make day-to-day decisions and strive for consistent growth that matches with long-term investment objectives. Another thing to consider is choosing the right investment app. We know that this age is the rise of technology, and many investment platforms have user-friendly interfaces and offer commission-free trades. It's important to research and compare different investment apps to pick the one that suits your needs and risk tolerance. Starting with a small amount is also essential when investing in the stock market, especially if you're a beginner. Starting with a small amount helps in easing into the investment and understanding market fluctuations and the workings of the stock market. It allows the investor an opportunity to make small errors while adjusting their portfolio rather than significant losses. Risks of stock market investing. Stock market investing can be successful, but there are still risks. Potential investors should be mindful of market volatility, which can cause major swings in stock prices. This makes emotions and impulsive responses inappropriate, whereas patience is required. Also, individual stocks may have risks such as bad performance or management, unexpected external circumstances or events, and regulatory changes that can harm the company. As such, diversifying one's portfolio can help reduce the risks connected with specific equities. However, it is important to remember that diversification cannot guarantee profit because risks persist no matter the number of assets. Recognizing this, one needs to do analysis and research on stocks before investing, including establishing the appropriate price to pay for a company's share. It is really important to gather lots of information, such as a company's financial health, management team competence, industry trends, and more. So remember, information is extremely important when it comes to investing in the stock market. Overall, investing in the stock market requires patience, research, and a focus on long-term goals. It's important to understand companies, their financial positions, market trends, and those inherent risks, as well as one's own temperament and investment objectives. A sound approach to stock market investing can lead to impressive returns, but it demands a proactive approach to research, analysis, and decision-making. So before making any investment, it is important to do your homework to set a strong foundation for investing success. Seems like a lot to take in at the moment. Don't worry. Once you start applying these rules when you invest, you will understand and navigate the world of the stock market better. Peter Lynch investment strategies have stood the test of time and are perfect for long-term success in the stock market. It's important to stick to his simple yet effective approaches, and that is number 1, investing in what you know. Number 2, doing your research, and number 3, being patient. Remember, market drops are normal, and sometimes even experts can miss out on great investment opportunities. So please, stick to your plan and don't be overwhelmed. It is essential to select investment options that are compatible with your mentality and investment goals. Equity mutual funds are ideal for beginners like you because they provide diversity and protection from significant decreases in stock prices. They do, however, contain dangers and necessitate research to select the correct funds. Ultimately, the key to stock market success is focusing on the stories of companies, such as positive changes in earnings, new products, improved management, and financial stability. Remember the investment principles by Peter Lynch, stick to your plan, and stay tuned to the company's progress over time. With knowledge and patience, you're sure to find success in the stock market. Well then, that's it! Are you ready to invest and become the next big thing in the stock market? Let's run down the 3 rules again. Number 1, investing in what you know. Number 2, doing your research. And number 3, being patient. Right, you're all set. Here's a little Peter Lynch quote to pump you up. People who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game. Good luck on your journey and thank you for watching. If you like this video, please don't forget to give a thumbs up, comment, and hit that notification bell so you don't miss out on our next videos.